Hey everybody, welcome. As you're cycling in, greatly appreciate you being here on today's episode of the Weekly Success Builder. I know I took a couple weeks off. I was out traveling, and of course we had Labor Day. So thank you again for tuning back in. Really excited to have today's speaker with us. Just kind of extremely timely about what's to happen here in this coming week and obviously into the future. So I'm going to introduce Terry Davis with Cotality. Cotality is a industry partner of NAM, and we're very grateful for the relationship and partnership, and very happy to have Selma Hepp with Cotality give us an economic overview. So I'm going to turn it over to Terry.
Awesome. Thanks so much, Val, for having us. I hope all of you all had a fantastic summer. Welcome to fall and conference season. Hope I'd see all of you in Las Vegas in next month. Listen, I'm here to introduce Selma and to have a great conversation with you about the economy, what's happening in housing, and what we should be thinking about in terms of a potential continuation of a rate drop, and what's happening in terms of home price appreciation and the shifting sands in terms of how to think about being in front of your customers and retaining your customers in the wake of losing credit triggers in the near future. So lots of good topics to cover. I'd like to introduce Selma Hepp. Selma is our chief economist at Cotality. She keeps an eye on all real estate trends, the macro economy, and how it impacts housing. She is an expert in this field, having several years of experience as a PhD in economics. I want to point out that in the chat, I put her monthly newsletter, and you can sign up for this newsletter in the URL that I posted. So you see the September newsletter there, and then a sign up on the left so that you can just get this on a monthly basis. And I think this is great content. If you're looking to grab content and put it in your social streams, or if you want to be out sending your customers emails representing yourself as a expert in your field, the content that Selma puts out on a regular basis is a really great resource. So with that, I would love to turn it over to Selma for a conversation about the economy and what we anticipate in terms of rates in the next little bit. Thanks, Selma.
Yeah, sounds good. Do you want to start with any questions, or should I just keep talking?
Why don't you just kick off with where we are in housing today, what trends you're seeing, and in particular, I know everyone wants to sort of think about how we should think about the anticipated Fed rate drop, and we've already seen rates trend down. What would you anticipate ending the year at, and how will that impact housing into 2026?
Sure. So, we unfortunately had a pretty difficult environment for the housing market, given the economic uncertainty, elevated mortgage rates, and affordability strain. So that has really held back home sales. It actually even weakened home sales both this year and last year in middle of the spring home buying season when mortgage rates went up. So it's been a very, very challenging environment for home sales activity, and as a result, we've seen home sales activity lagging. No matter which way you look at this indicator, it's some of the lowest levels that we've seen. So whether you compare just nominal sales or you adjust for population, which is something that to me is more interesting because population has grown over the last 30-year period. And we oftentimes, in recent times, have said that home sales are at the lowest that they've been since 1990s, and home population in the U.S. has gone up some 75 million people. So adjusted for that, home sales is even lower. But what's been really encouraging to me this year is that we do have more inventory. That was a big constraint over the last couple of years. So finally, we had thawing out of that inventory. Lock-in effect to some extent we do see in many markets, not all markets, and this is where bifurcated housing market picture comes in, but inventory is increasing in many markets, and that has really helped a slowdown rate of home price appreciation. In terms of home price appreciation, we are currently at some of the lowest levels since 2012. Home prices were up in the latest reading about 1.4%, Cotality Home Price Index that was released last week. And actually what was interesting in that report is that home sales declined from June to July, which is not something we typically see at this time of the year, right? Usually throughout going into spring home buying season and all the way until fall, you see home appreciation heat up and then slow down, but generally remains positive. So this decline really suggests continued cooling in demand in the housing market, and the fact that home prices are really stalling at this point. We saw home sales stalling, and now home prices are stalling as well. So what does that mean going forward? Mortgage rates have come down, fortunately. By many accounts, I would say that mortgage rates have already priced in this week's Federal Reserve rate cut. So I don't anticipate much lower mortgage rates than where we are today. When we think about mortgage rates, what drives mortgage rates, and people think about that Federal Reserve is the biggest game in town here when it comes to mortgage rates, but it's really not. We all know mortgage rates are priced off of 10-year treasuries. 10-year treasuries price in expectations of monetary and policy, fiscal policy, economic growth, as well as inflation. So every time we have a hotter inflation reading, things bounce back. When we have slower employment report, things come down. And so we did have slow employment report over the last month or so, and so that's really drove the expectation of a Federal Reserve rate cut this coming week. Now, on the other hand, we do have inflation readings that are not coming in hot, but they are warming up, if I may put it that way. They're a little bit warmer than they were at the beginning of this year, prior to all the tariff discussions. So the fear is that we may see more inflation coming in as the year progresses and into 2026. In fact, most of the forecast for inflation is to pick back up to 3% average, which is above that 2% target rate that the Federal Reserve has. So, Federal Reserve is now in this really uncomfortable situation where their two mandates are moving in opposite direction. Inflation is heating up, unemployment is increasing, or let's say job creation is slowing. We haven't quite seen rate of unemployment increasing significantly, but job creation is slowing, which may in turn mean a higher unemployment down the road. And again, that's part of the forecast going forward. So, and given the two opposing mandates that they have to very carefully sort of balance which priority they're focusing at the moment. And right now, it seems that the employment is the priority that they will be focusing on, hence the expected rate cut. But that's, further rate cuts in 2025 are not guaranteed. Again, it depends what happens with the inflation. A lot of the forecasts do have a couple more rate cuts expected for this year, but as I said, we'll see what happens with inflation, and how does that change Federal Reserve's focus from, say, employment to inflation. So, okay, what else I wanted to say? Maybe a little bit on bifurcation in the housing markets. I mentioned that we did see slowing of home price appreciation. In some markets, you do see home prices actually decline, particularly markets in Florida, markets in Texas, and markets in the West, where home prices are now down on a year-over-year basis. Again, those are the markets where we do see more inventory, as well as have had more new construction. So inventory overall is keeping the pressure on home prices lower, but also demand has weakened due to some additional concern that have arisen over the last couple of years, namely cost of insurance, property insurance, and as well as property taxes that have gone up a lot in some areas. So that's keeping pressure on demand. That's keeping the demand lower. On the flip side, you have markets in Northeast, Midwest, where inventory still lags, and it's down some 50-60% behind 2019 levels still. So not much improvement in inventory and continued demand. Remember, in Midwest, it is one of the most affordable parts of the country. It has seen relatively strong job growth in recent last couple of years. And so that's really helping boost demand for housing in those markets. And so home prices in Northeast and Midwest is still in higher single digits, 6 to 9% on average, versus those declines that we see in markets in the South and Southeast and the West. So that's sort of the picture. If you have, maybe we can dig into specific questions.
Yeah. Val, any questions from you before we tackle the chat and just engage in conversation?
Sure. I saw an article the other day, I think that is now saying there's going to be 3 rate cuts. Are you agreeing with that? I'll just call it a guesstimate because nobody really knows. And how do you think, I know you said the rate cut coming up has already been baked into the rate. If we do have 2 additional rate cuts, how do you think that is going to affect everything?
Yeah, so I don't think 3 rate cuts. Again, I think that we cannot underestimate how much inflation is still weighing on the minds of especially Jerome Powell, giving his legacy to not repeat what happened in 1980s. So, I don't think anything is guaranteed, Yes, we may say, okay, we expect 2 rate cuts, 3 rate cuts, but nothing is guaranteed. They are still very, very much data driven, and whatever next reports over the next couple of months show, that's gonna drive their decision for the moment. So I don't, so I expect another rate cut this year. Maybe not necessarily 3 rate cuts, because I do think that inflation, is starting to heat up again. And in terms of the rate of unemployment and the just in general job growth, what we saw starting in sort of spring, when the tariff discussions were on the scene big time, when it was all about the tariff discussions, we saw a lot of companies decide to stay on hold in terms of hiring, in terms of doing any sort of HR decision making. And I think uncertainty is still an underlying descriptor of the current economic conditions, but I think people feel a little bit more comfortable in making those type of decisions. So we may see some hiring going forward. The recession, which is what would really drive more rate cuts over the course of next 6 months, is not guaranteed. Yes, some folks are expecting a recession, but majority of folks are seeing that things are still moving relatively solid. I guess that you could say.
Right. So I have 2 more questions. So question number 2 is, I know we talk a lot about these labor market numbers, and the jobs, we're all like, oh, what's the jobs market number every month? Can you just explain? So like, we get these jobs numbers and unemployment rate numbers every month, and then I guess the Bureau of Labor Statistics actually gives us the real numbers. What is it? I don't know, 6 months later. How does that work exactly? Because it's very confusing, because we're all sitting there waiting. And the one poor woman got fired because,
Yeah.
President Trump didn't like the information that she gave. But how does all of that work? And does that have an extreme effect on the interest rates?
Well, it seems to have a sizable impact on interest rates in general, because markets do move. We've seen markets move a lot with that Friday, monthly Friday job report. But unfortunately, it's not it's easy to put a blame on somebody. It's not just one person or one organization. The fact is that job numbers are collected based on a sample of responses, survey responses. And we've all, whomever, if you've done a survey recently or participated, well, fewer and fewer people are participating in survey, which is the main problem behind why the revisions have gotten to be so large. Because when they're trying to release that first Friday report data, they have a very small sample of responses. And as the months go on, you get more responses, you get wider responses across wider range of sectors, you just get better information, and then you're able to make those revisions. So it's just nature of the beast. We historically have collected this data using surveys, and surveys have grown to be increasingly unreliable because people don't like to take them. A lot of folks don't even have home phone anymore. We all have cell phones. You don't answer the cell phone if you don't know.
When something comes up as spam or survey,
Yeah,
chances
yeah.
are I'm not
Exactly.
answering the phone. I mean, it's almost, they're gonna have, it seems as if they're going to have to completely overhaul the method in which they're gathering that information, because if you're relying on the general public to answer the phone, chances are it's retirees who aren't working.
Well, the other thing is, when you have turning points in the economy, you do tend to have a relatively larger revisions, because you're basing you benchmarked a year ago when things were maybe a little bit hotter, or there was more job creation, and since then things have slowed down, but you're benchmarking against something that, a trend that was happening a year ago. So when the economy is slowing, you do tend to have overestimation of job creation. When the economy is heating up, you tend to have underestimation of job creation. And that's, because of, small companies, again, tend to be created more frequently in a heating economy, and vice versa. And so that's another contributor to this. And smaller companies don't necessarily have time or bandwidth to respond to surveys, so that we can get a better sense right away, with a more timely data input.
Okay. I do see where someone asked a question. I guess that CNBC Fast Money Market Watch last Friday, a guest economist said that they're expecting 5 rate cuts between now and mid 2026. I mean, how many rate cuts do you really think we're going to have? Because 5 seems excessive to me.
Well, I mean, if you think about it, each rate cut is 25 basis point, 5 rate cuts is a one and a quarter percentage points in total, right? And that would bring the Federal Reserve rate back in the long run trend. So, discussion I haven't heard this particular discussion, but I've heard 5 rate cuts, and so, expectation is that we just want to get back to what they call R star, a Federal Reserve rate at which you are neither heating up the economy nor cooling the economy. And right now we are still in relatively more restrictive environment for interest rates. So, the idea is that maybe, a lot of analysts think that, okay, from week to week, you'll get new data, and expectations will change on whether we are in recession or not. A few weeks ago, we were especially following that employment report. There was a lot of expectations of recession over the much higher probability of recession over the next 12 months. That has now shrunk a little bit. So again, it's such a moving target that I wouldn't, I would just be cautious in reading into it without waiting for each next report on what's happening in the economy.
Gotcha. Yeah, I get it. Like, who has the crystal ball if, we
Only we
Yeah.
did. Yeah. But if we look into 2026, what's our forecast for 2026 new home sales, or not new home sales, but home sales? If we exit 2025 at something around 4 million, what do you think we'll exit 2025 at? What do you think 2026 will be in terms of home sales?
Yeah, mostly some positive increase. I've seen forecasts between about 2 to 5% increase in total home sales. It depend. Inventory will help here, rates will help here as well. So, 2 to 5%, I'd say.
Yeah, so
I've seen higher expectations too, but I would say, more reasonable one is that lower single digits. So some increase, yes. I mean,
yeah,
we won't see, affordability is still a huge problem, in most of the country, or at least in the parts of the country where you have most home sales activity. One could say, okay, Midwest is affordable, but out of the totality of home sales activity, Midwest is much smaller share of that total, and a lot of home sales, when you think about over the last few years, were in South and Southeast, Florida, Texas, and that Southeast section. That's where we've seen largest slowdown. Actually, in 2025, most of those markets are down 20+% on a year-over-year basis in terms of home sales. So that's dragging that overall activity down.
yeah. I did read this morning that Florida and South Carolina are leading the nation in foreclosures, Las Vegas being the third. So there definitely tracks with what you're saying about the Southeast. And we know that the West is under a lot of pressure for similar reasons, the high cost of taxes and insurance, especially.
Yeah, absolutely.
Would you mind, are you okay with answering or stating your opinion regarding the Fed chair? Ask a question regarding that, about the Fed chair?
Yeah.
Okay, so there's a lot of conversation about the Fed chair, Jerome Powell. We know his term's going to expire in 2026. How would whoever the new Fed chair is that President Trump appoints, how do you think that their approach is going to differ from current leadership from Jerome Powell? And how is that going to affect the interest rate policy? Because we know Jerome Powell's being extremely conservative. As you said, he doesn't want to go back to the 1980s. None of us do. But there's been a lot of emphasis placed, whether it's President Trump, FHFA Director Pulte. I saw where Director Pulte and I believe the Treasury Secretary Bessent got into a verbal altercation last week. Who do you think it might be, or how do you think that that's going to affect what the new rate policy is going to be?
Yeah, so I mean, we know what President Trump thinks about mortgage interest rates. Like, we know he thinks they're too high, and all the descriptors that he used for the Federal Reserve chair. So I think whomever he chooses, it's going to be somebody who is more aligned with his beliefs, or his perception of the where the interest rates should be. So it's going to be somebody more dovish, meaning that they're more likely to have more cuts. So, when one talks about the Fed 5 rate cut, that could very easily happen, even more if if there is a dovish person. But again, there's a group of people. It's not just up to certain people, but if you have dominance of people who are dovish, obviously, that may prevail then the decision making. So that's so I do think that rates are going to be lower when president put somebody new in that position, relative to if Jerome Powell was to stay, because what Jerome Powell also worries about is debt levels down the road, fiscal situation and other things. And I am worried that, if there is not, if that, we talk a lot about the independence between the Federal Reserve and the administration. And so if that line is blurred, I just worry, what does that mean for investors' expectations on bonds? And we know mortgage rates are priced of bonds. So again, even if you have lower federal funds rate, does not necessarily mean you'll have lower mortgage rates. There's not one-to-one ratio. And the other thing is, I just had I blanked for a second, but I remember now what I was going to say is that, when you do, because we have so much pent-up demand, I keep emphasizing this, in terms of home prices, how much actually current slowing of home price appreciation is actually helpful for the housing market. Because when you do have lower mortgage rates, because we have such pent-up demand sitting on the sidelines, I think we're going to have a bounce back in home price appreciation as soon as mortgage rates come down. So you're not getting any
Relief.
Yeah,
affordability.
there's going to be no savings there.
So,
Yeah.
so it's going to be hard to get that affordability improved, even with lower mortgage rates.
Yeah. It's also important to note that the Fed chair only is one vote.
Yes.
Right, there's a board of governors that also vote, and so they can't wholesale change all of those Fed governors in a single movement and get a huge change in policy. You can have a dovish chair, but I think that their level of influence over the whole board is TBD.
Yeah.
Right.
Yeah.
Right. And I also wonder too, if we're starting to consistently lower the rates, what are we setting ourselves up for in the future?
Yeah.
I mean, we all
Yeah.
loved 2020. It was amazing. We all
It's
made
not
great
happening
money,
anytime soon.
but look what we did to ourselves.
Yeah.
We did not help ourselves. We only hurt ourselves. So, it's that part is a little scary too, because it's fearful that they're not looking down the road. They're only looking 3 steps in front of them, not a mile.
Yeah. Yeah.
Well, unfortunately, we're not going to solve the world's problems on this call. but I do greatly appreciate all of the insight. Please subscribe to the Cotality newsletter. I will also put that in the link in the posting on the weekly Success Builder section of NAM Hive. And I mentioned earlier, Terry and Selma, anytime you want to post in NAM Hive about anything economic related, anything Cotality is working on, we know you're a great source for data and information. Please feel free to do that. So thank you, everyone. Thank you very much for joining us. I greatly appreciate all the insight and your time. And
Great job,
everybody makes the rest of the week a great success.
Thank you very much.
Thank you.
Loved having you. Thank you.
Appreciate it.
Thank you, guys.